Hello everyone and welcome back to my channel, Investing with Lorenzo Mellone. In this channel, I'll always be realistic, no promises of quick riches or unattainable goals. Instead, we'll approach the stock markets with reason, aiming for solid returns through a qualitative approach and by seeking opportunities with a favorable risk-reward ratio. Like most of you, I'm an employee, and we all know how hard it is to get rich solely through a salaried job, unless you become a CEO, of course. The only real ways to build wealth are by starting your own business or becoming an investor. Starting a business is often very risky. Not everyone has the funds, knowledge, or even the right personality or drive to run a company. But here's the fantastic news: everyone can be an investor. This means we all have the same or nearly the same opportunities as a business founder to grow our capital, but passively letting others to do the work for us. However, we need to make a distinction here. The investors who've grown wealthier than average are those who concentrated most of their capital in a few winning companies, not many companies or ETFs, even though ETFs are a relatively recent financial tool. Most companies in major indexes underperform the market, and many even deliver negative returns. The indexes are driven by the best performers, which mask the poor performance of the rest. So why buy all of them through an ETF? Today, let me take another point of view, and let's try to focus on the benefits of the active investing strategy and why not just pick the best stocks from that index. This is an active approach known as stock picking, the strategy that I use. Of course, selecting them isn't easy, and most investors fail to capture the best single stocks underperforming the benchmark index. While it's not simple to find tomorrow's winners, we can certainly avoid the worst companies by paying close attention to their fundamentals. To give you a concrete example, let's look at this data comparing the S&P 500 market weight versus equal weight indexes. There are different index construction methodologies for the S&P 500. The traditional version weights companies by market cap, while the equal weight index gives each company the same weight. This difference impacts performance. The market cap weighted S&P 500, the standard version, is more concentrated in large growth companies, while the equal weight index has more exposure to smaller and value-oriented companies. We can see that the one-year performance gap between these two indexes and their corresponding ETFs is enormous. The market cap weighted version, driven by the winners, has outperformed the equal weight by 18%, returning 30% versus 12%. This performance gap remains significant over 3, 5, and even 10 years. Only after 15 years does the equal weight show a slight outperformance, but it's so minimal that it hardly justifies choosing it, given the time required just to catch up, with no guarantee it will hit in the future. For example, in 2022, the S&P 500 dropped 19%, but 60% of stocks belonging to the index fell more than 20%. In 2021, 35% of Nasdaq-listed companies closed in the red, even though the index was up 27%. This brings me to a key point. Diversification is often recommended. Spreading your portfolio across uncorrelated assets, predefined allocations, stocks, bonds, emerging markets, commodities, gold, etc. The idea is that if one asset performs poorly, it won't drag down your entire portfolio, since you've only allocated a small portion to it. There's nothing wrong with this strategy, and it's undoubtedly the right approach for most investors. However, excessive diversification can be just as harmful. When you diversify too much, you sacrifice returns. That's the risk of over-diversification. The S&P 500 equal weight is a perfect example. It's as if you picked 500 companies. Technically, the index had 503 as of June 2024 and gave each the same weight in your portfolio. Why does diversification sometimes hurt returns? Because when you add too many assets or weakly correlated stocks, it's inevitable that some will underperform or decline each year, dragging down the overall portfolio. Even if you find a future 10-bagger, if it only makes up 1% of your portfolio, its stellar gains won't move the needle much. You'd likely feel more regret for not investing more than joy from the profits. I'm not talking about impossible stock picks, just companies that deliver 10x returns. You don't need to find a penny stock for that. Think of Apple or Amazon in 2014. They were already well-established household names. Yet, from 2014 to their peaks this year, Apple returned 10x, Amazon returned 14x. For example, if you had invested 1,000 euro, you'd have 10,000 euros today. Great, but you'd probably wish you'd invested more. While if you'd invested 10,000 euros, you'd have 100,000 euros, which would have lifted your entire portfolio much more significantly. Remember that Warren Buffett, Peter Lynch, and Munish Pabrai, for example, built their wealth by concentrating on a few winning stocks, not over-diversifying. That was the secret to their compounding effect. If you want to dive deeper into compounding, I made a video called The Magic of Compounding. Feel free to check it out. As Warren Buffett once said at a Berkshire Hathaway meeting, diversification is protection against ignorance. It makes little sense for those who know what they're doing. What do you think? Are you a stock picker? Do you prefer a few strong ETFs or maybe a hybrid approach? A core portfolio of ETFs with a satellite of individual stocks? Let me know in the comments below, and as always, if you enjoyed this video, hit the like button and subscribe so you don't miss the next one.